What are the risk benefits typically seen if purchasing properties at less than 250k and 7% yields? What should we consider to avoid problems? Public housing, generally the rule is when prices are cheaper, it means that there is usually a reason why they are still low. It generally means, think back, I mean, this might be a pretty random example, but think back 200 years, right? Properties range between 80 cents and $1 or $1, I don't know, this is just a crazy example, but then it's the compounding that is applied over time that has created properties that are now worth $200,000 and $100 million. So changes in the compounding growth rate of those properties that has created that discrepancy. For these properties down this end of that discrepancy, there is an underlying factor. Whilst over the longer term, over the last 50 or 80 or 100 years, they are still here, whilst there are properties now worth $100 million in Australia. Okay? What is that reason? It's not to say that I wouldn't buy it. I have to be very sure that those underlying reasons that were holding the prices back has been broken free. Is there a state level policy where they've just built a hospital and they are looking to move population into that area? Wagga Wagga, Bendigo. Dramatic changes in public policy and perception that fundamentally shift an area and move an otherwise $200,000 area up to $400,000 within 2 or 3 years. And we've seen it time and time again. We follow that across the country. Okay? I want to see those strong breaking free, those constraints being removed for the $250,000 properties. I have to see that. And then when you get into that price point, it's like a minefield, right? You've got to be careful of things like public housing, localized perception. I can remember a story of Bendigo. It was one of the cheaper areas, California Gully in Bendigo. Our on-the-ground partner in that market said, as of today, I'm not buying in that street because someone was stabbed there on Friday night. Okay? These are the things that as an investor, when you go into those markets, that lower end of the spectrum, you have to be sensitive of. We don't really go there. When we invest at a $250,000 price point, it is right down the lower end of our spectrum. It's generally just over 300 is our absolute minimum now. We are looking at those drastic chains being broken, very strong changes to a market. And we then look through properties with a very fine tooth, a very fine magnifying glass to find those sweet spots. Okay, that's probably how we would do it. They do still exist. We were looking at properties last week that were just under $300,000, just under 6% yield, an off-market property that was presented to us. They are still there, and that was in a location that is meeting all of our boxes, in that good, strong location that is going ahead and in a good street pocket. So they still are out there.